How are you? We are waiting for Miss Lagarde. Dun, dun, dun. Okay, here we go. In a few minutes. Look what happened in Nasdaq. Actually, this is the MES, the micros. I had some small trade before the news. Let's see.
Good afternoon and welcome to our press conference with President Lagarde.
Hello, hello.
And Vice President de Guindos. My name is Wolfgang Preußel. We are also connected via video link to some journalists. If you take the floor and ask questions, please unmute and open your cameras.
We want.
And with that, I hand over to President Lagarde, please.
Well, thank you very much, Wolfgang, and good day to all of you.
Hello, hello.
The Vice President and I welcome you to our press conference. The Governing Council today decided to keep the three key ECB interest rates unchanged.
Okay.
Inflation is currently at around our 2% medium-term target, and our assessment of the inflation outlook is broadly unchanged.
Really?
The new ECB staff projections present a picture of inflation similar to that projected in June. They see headline inflation averaging 2.1% in 25, 1.7% in 26, and 1.9% in 27. For inflation excluding energy and food, they expect an average of 2.4% in 25, 1.9% in 26, and 1.8% in 27.
Okay.
The economy is projected to grow by 1.2% in 25, revised up from the 0.9% expected in June. The growth projection for 26 is now slightly lower at 1%, while the projection for 27 is unchanged at 1.3%.
Nice.
We are determined to ensure that inflation stabilizes at our 2% target in the medium term.
Okay.
We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it.
Nothing new from
Lagarde. In light
Lagarde.
of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website.
Okay.
I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economy grew by 0.7% in cumulative terms over the first half of the year on account of the resilience in domestic demand. The quarterly pattern showed stronger growth in the first quarter and weaker growth in the second quarter, partly reflecting an initial front-loading of international trade ahead of expected tariff increases, and then a reversal of that effect. survey indicators suggest that both manufacturing and services continue to grow, signaling some positive underlying momentum in the economy. Even if demand for labor is softening, the labor market remains a source of strength, with the unemployment rate at 6.2% in July.
Okay.
Over time, this should boost consumer spending, especially if, as foreseen in the staff projections, people save less of their income. Consumer spending and investment should benefit from our past interest rate cuts feeding through to financing conditions. Investment should also be underpinned by substantial government spending on infrastructure and defense.
Okay.
Higher tariffs, a stronger euro, and increased global competition are expected to hold growth back for the rest of the year. However, the effect of these headwinds on growth should fade next year. While recent trade agreements have reduced uncertainty somewhat, the overall impact of the change in the global policy environment will only become clear over time. The Governing Council considers it crucial to urgently strengthen the euro area and its economy in the present geopolitical environment. Fiscal and structural policies should make the economy more productive, competitive, and resilient. 1 year on from the release of Mario Draghi's report on the future of European competitiveness, it remains essential to follow up on its recommendations with further concrete action and to accelerate implementation in line with the European Commission's roadmap.
Okay, nothing new from Lagarde.
Governments should prioritize growth-enhancing structural reforms and strategic investment while ensuring sustainable public finance. It is critical to complete the Savings and Investment Union and the Banking Union to an ambitious timetable and to
Okay.
rapidly establish the legislative framework for the potential introduction of our digital euro. Looking now at inflation. Annual inflation remains close to our target, edging up to 2.1% in August from 2% in July.
Increase.
Energy price inflation was minus 1.9% after minus 2.4% in July, while food price inflation declined to 3.2% from 3.3%.
Nice.
Inflation excluding energy and food stayed constant at 2.3%. Services inflation edged down to 3.1% from 3.2% in July, while goods inflation was unchanged at 0.8%. Indicators of underlying inflation remain consistent with our 2% medium-term target. Year-on-year growth in compensation per employee was 3.9% in the second quarter, down from 4% in the previous quarter and 4.8% in the second quarter of last year. Forward-looking indicators, including the ECB's wage tracker and surveys on wage expectations, suggest that wage growth will moderate further. Along with productivity gains, this will help keep a lead on domestic price pressures, even as profit recover from low levels. Looking ahead, the staff projections see food inflation dropping from 2.9% in 25 to 2.3% in 26 and 27. Energy price inflation is expected to remain volatile but rise over the projection horizon, in part because of the start of the EU Emission Trading System 2 in 2027. Inflation excluding energy and food is expected to fall from 2.4% in 25 to 1.9% in 26 and 1.8% in 27, owing to the stronger euro and declining labour cost pressure. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. So moving now to the risk assessment. Thank you. Risks to economic growth have become more balanced. While recent trade agreements have reduced uncertainty, a renewed worsening of trade relations could further dampen exports and drag down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions, greater risk aversions, and weaker growth. Geopolitical tensions, such as Russia's unjustified war against Ukraine, and the tragic conflict in the
unjustified
Middle
war,
East
the usual
remain
bullshit.
a major source of uncertainty.
Come
By
on.
contrast, higher than expected defense and infrastructure spending, together with productivity enhancing reforms, would add to growth. An improvement in business confidence could stimulate private investment. Sentiment could also be lifted and activity spurred if geopolitical tensions diminished or if the remaining trade disputes were resolved faster than expected. The outlook for inflation remains more uncertain than usual as a result of the still volatile global trade policy environment. A stronger euro could bring inflation down further than expected. Moreover, inflation could turn out to be lower if higher tariffs lead to lower demand for euro area exports and induce countries with overcapacity to further increase their export to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial
Only
markets,
gold is going
which
up.
would weigh on domestic demand and would thereby also lower inflation. By contrast, inflation could turn out to be higher if a fragmentation of global supply chains pushed up import prices and added to capacity constraints in the domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term.
Okay.
Extreme weather
We
events
see
and the
stocks
unfolding of
stalling a
climate
bit
crisis
here.
more broadly could drive up food
Let's
prices
see.
by more than expected.
If we get a trade around 56, 57.
So looking at the financial and monetary conditions. Since our last meeting, short-term market rates have increased, while longer-term rates have remained broadly unchanged. However, our past interest rate cuts continued to lower corporate borrowing costs in July. The average interest rate on new loans to firms
We see a big
moved
order at
down
60.
to 3.5% in July from
Okay,
3.6%
that's what
in June. The cost of issuing market-based debt was unchanged at 3.5%. Loans to firms grew by 2.8%, slightly more strongly than in June, while the growth of corporate bond issuance rose to 4.1% from 3.4%. The average interest rate on new mortgages was again unchanged at 3.3%
Nasdaq is pumping
in July,
here.
while growth in mortgage lending picked up to 2.4% from 2.2%.
I think it's gonna be a Shopfest.
So in conclusion,
Today.
the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining
The usual bullshit,
appropriate
nothing new
monetary policy
from
stance.
Lagarde.
Our interest rate decisions will be based on our assessment of the inflation outlook
Yes,
and the
yes,
risks
okay.
surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We
Okay.
are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Okay.
First question goes to Jana Rando of Bloomberg. Jana, please.
Right, let me organize myself.
Hello, good afternoon, and thank you for taking my questions. Madame Lagarde, economists believe the ECB's easing cycle is over, and with the outlook broadly unchanged, as you mentioned, would you say they're right? And would you say everybody on the Governing Council agrees on that assessment? And my second question is about inflation. You mentioned a whole bunch of inflation risks, and I am wondering, would you say they are balanced? Thank you.
Well, thank you so much for your two questions.
Same bullshit again from Lagarde.
Let me say this.
This arrogant that the
The
French have.
disinflationary process is over. And I'm referring here to the causes for inflation that we
Inflation
have
is over,
experienced
okay.
in the last few quarters.
They are sleeping tight.
In anticipation of the
With
possible
that.
questions, are we still in a good place? Well, we continue to be in a good place.
You think
Okay?
you are.
Now, why do I say that? Because inflation is where we want it to be. Latest reading 2.1, 2.1, medium-term outlook, on
Let me
target.
sell some euro on this bullshit.
The domestic economy is showing resilience. The labour market is solid, and risks are more balanced. But when I say that we are and continue to be in a good place, am I saying that we are on a predetermined path? No. Because in the same breath of air, I say that we decide, meeting by meeting, that we are data dependent, and that we will decide accordingly in order to make sure that we stay in a good place. So I hope I'm making myself clear in that respect. We continue to be in a good place, but we are not on a predetermined path, and we will take stock, meeting by meeting, to look at the data, all the data, the outlook, the projections, the many data that we receive, in order to make sure that we stay in a good place. So, does everybody agree with that?
With
You know,
what?
I never want to overstretch the general agreement in the room, but we had a unanimous decision by the Governing Council today
Euro.
to leave all three interest rates unchanged. And we discussed, of course, the projections, we discussed the risk, but I think that what I have just formulated for you is something that was agreed unanimously around the table. On your second question, which deals with the risk to inflation, we don't actually narrow down the risk to inflation exclusively. We assess the risk on the activity, on growth. And that's where we say in our statement that risks are more balanced. But we don't nail down a risk diagnosis on inflation in isolation. But I'll be happy to come back to why we are more balanced. Maybe somebody else will ask that question. Who knows?
Next question goes to Annette Weisbach of CNBC. Annette, please.
Annette Weisbach, CNBC. Thank you for taking my question. I'll just follow up on that question. So, why do you think risks are more balanced now, given the uncertainty still which we see elsewhere in the world? And of course, I need to ask you about France. We've seen, of course, that the political situation and the unstableness of the country has driven bond yields quite high. So, how concerned are you about a déjà vu which we had some years ago?
Let's
Thank you.
sell some
Not with France, but with other
stocks
countries.
here. Thank you.
God, I like it when you start speaking French. Déjà vu, huh?
Went to school there, right?
Déjà vu, déjà vu.
So, more seriously, more balanced. I thought about it because I thought that one of you might have the question. You have to go back to where we were back in June, really, where we do the assessment of risk on the basis of the projections. And if you walk back to June, we had a highly uncertain situation. It was post-April 19, sure, but it was pre-July and certainly pre-August 21 when a deal was agreed and documented, however it was documented, but documented. And as a result of that, I think that two things have clearly moved out of our radar screen when it comes to downside risk. The first one is the risk of European retaliation. That was factored into our June projection, and that was considered as one of the risk in a trade war, as we had it at the time in terms of fear. The second thing is the uncertainty. So, what we call trade uncertainty, that has clearly diminished, and we can see that in the instruments that we use to measure uncertainty. It has not gone back yet to where it was pre-COVID. It's not the sort of normal level, and maybe there will not be a normal level. That's something that we really have to consider and take into account for future determination. It could well be that there was a reset in uncertainty around the world because of the trade situation, because of the geopolitical environment in which we operate. But the trade uncertainty has abated since June, when we had our last projection. So that's really what is at the root of this more balanced indication. It's not to say that risks have vanished. It's not to say that we are short of challenges. There are new risks probably, there might be new ones, there will be new challenges, which really sort of anchors our determination to work meeting by meeting and to assess each and every time what the situation is. And we are post new strategy, and you will remember that one of the innovation in our new strategy is that we not only look at the baseline, but we look and discuss the risks around the baseline on the basis of work that is sometimes published, sometimes not published necessarily, which is sensitivity analysis. I see some of them saying, what, it's not published? There are certain things that we keep to ourselves, yes. We publish a lot, we share a lot, but sensitivity analysis, scenario analysis, and sometimes we do publish the scenarios, for instance, sometimes we don't, because we don't think it's absolutely relevant or helpful. But
And euro keeps going
at
higher.
least it informs our judgment.
It's all about the
And
dollar.
you have the second question. Yeah. Look, I'm not going to comment on individual countries. I avoid that because we are the European Central Bank. We are not, narrowing our judgment on a particular country. But I would say that I'm confident that the policymakers, that those who make decisions, will take it to heart in that period of uncertainty to reduce uncertainty as much as possible.
Okay.
There is also a set of rules that is the fiscal governance, the fiscal framework.
Fucking euro going higher?
The internal rules of
What the
the
fuck?
European countries, and the member states have to adhere to it, have to deliver against it, and I'm sure that all governments, wherever located, will want to operate on the basis of that fiscal framework. Thank you.
Francesco Canepa of Reuters, please. Francesco.
Francesco!
Good afternoon. So you said that inflation is projected to be a target over the medium term.
Yeah.
Yet the projection for 2027 is at 1.9, so below 2 for the second year in a row. So where does below target start?
Where it
The second question is again about France in terms of the specific.
Tell us about the French
CPI.
problems.
How far are we from a
No
disorderly
problems there.
and
All
unwarranted
good.
move on the bond market?
Call a spade, eh? Okay.
Always.
So yeah, you're right. So let's go to the inflation projections,
Let's
if
go.
you will, because that's your first question. We have projections for 25, 26, 27. 25 and 26, we have increased by 0.1% our projection, right? So 26, our projection is now 2.1, and we've increased it by 0.1 in 26. We are now at 1.7. So in 27 we are at 1.9, and that's, first of all, it's a big 1.9.
Big.
But it's really on account of the exchange rate impact with the lag
Very
effect that
big.
it usually has, and this is factored into our projections. That explains to you the the fat 1.9.
The fat 1.9.
I would also refer you, and I don't need to do that because you're very familiar, but we have indicated very clearly in our strategy that minimal deviation will not necessarily, if they remain minimal and not long-lasting, will not necessarily justify any particular movement. So
what?
on the second question that you asked me, and this relates to France, I suppose. So I'm going to tell you the same thing. I'm not commenting on any particular country.
Okay.
But suffice to say that we always monitor market developments. And euro area sovereign
Yes, we are vigilant.
are orderly and are functioning smoothly with good liquidity. That's what we see. Okay? But our focus is, as you know, price stability, but we need financial stability for that.
Yeah.
And it requires a well-functioning monetary policy transmission mechanism. And we believe that we have all the necessary tools, if needed,
Really?
should that transmission not prove efficient
You
throughout
are
the
so
entire
good.
euro area. Thank you.
Next question goes to Aude Kasulek of the French TV channel BFM Business.
Stop, Phil.
Aude, please.
Thank you for taking my questions. Do you consider that quantitative tightening significantly contributes to the monetary policy stance, and to what extent does
Nice
it reinforce tighter financial condition or not? And second question, do you consider that a widening in of certain spreads over Germany will pose a serious threat to the transmission of monetary policy, and in such a case, could this trigger the use of the TPI even in case of major fiscal challenges for some countries?
Thank you for your two questions. So
Yes,
on
so
the,
boring, so fucking predictable. Thank you for
on
your
your
two
first
questions.
in the situation where we are of this disinflationary process,
Only me
and
getting
having
annoyed by Lagarde.
increased rates from
Type in
minus
the chat.
50 basis points to 400 basis points. The most efficient and primary tool that we use for monetary policy stance is the interest rates, as you will have seen. And we have cut interest rates by 200 basis points over the last 12 months or so. The fact that we are not reinvesting and that we are letting our portfolio on a runoff mode is proceeding smoothly. We had telegraphed it very carefully, it was anticipated, it was predictable, and I think that everyone who cares about those issues knows exactly how this proceeds and what very limited impact it has. That's a resolution that we have made, that we have explained very clearly to markets, and it proceeds accordingly. Now, as I said, we are always monitoring financial market developments. As I said as well, euro area sovereign bond markets are orderly and are functioning smoothly with good liquidity. If you observe the spreads, they have considerably tightened over the course of the last 2 years.
Come on, bond
and,
vigilantes.
the spreads relative to bonds
Do your job.
have a rather limited width between the other member states relative to the German bond. Thank you.
You're welcome.
Next question goes to from the Bulgarian news agency VTR, Stas Stampolsky.
Bulgaria News Agency, wow.
Hello, thank you for having me. welcome the Bulgarian governor Dimitar Radev as observer.
Yes, they are going into Euro.
1st of January, when Bulgaria will become the next Eurozone member. How you see the benefits and the risks of Bulgaria to become part of the Eurozone regarding maybe inflation and deficit, and how you see the Bulgarian input in terms of the monetary policy decisions?
Well, thank you for your question, and you give me a chance to say something that I wanted to say in the first place, which is that on the occasion of this Governing Council meeting, we had a chance to welcome 2 new members around the table. The first one was the new governor of Austria, Martin Kocher. Forgive the pronunciation. I'm doing my best, but who has joined us to replace Mr. Holzmann. And the other person that we greeted at the table was indeed Dimitar Radev, the governor of the National Central Bank of Bulgaria. Now and I would like to welcome those of you from Bulgaria, because I know that there is a number of you who are present in the room, and I hope your colleagues will
Viva Bulgaria! We love
you,
Bulgaria!
I certainly welcome you, and I know that you are spending a little bit of time with us, and it's very, very welcome, because it's wonderful to accept and to include a new member around the table of the Governing Council, and to have Bulgaria join the Euro area and share our currency, which is now euros as of January the 1st. So, having said that, you bring me back to a couple of decades, more than a couple of decades ago, when all of us moving into the euro from wherever we were, the Deutschmark, the franc, the lira, the pesos, we had this anxiety. What was that change going to be about? Would it work? Would it function instantly? And surprise was to the upside, I can assure you. So it worked. It removed this nightmare of having to change from your local currency to another currency if you wanted to either travel, transact, or conduct any kind of business with other members of the European Union, part of the euro area. So exchange was facilitated.
But why? Leva was
that?
good.
Because of stability. And that's really as you know, it's the core of the mandate of the ECB to provide stability, price stability, and the fact that inflation is very precisely targeted for the medium term, and that our monetary policy is aiming and taking all the necessary steps in order to deliver on our commitment to target, is something that
boring.
the states benefit from. So it requires on the part of those in charge of monetary policy to participate in the discussion.
I'm going
so
to drink
Bulgaria has a view
my coffee
and can express it, and I trust
will come
Governor
back for
Radev to do so.
US
Bulgaria
market. Okay.
has a voice, so you can comment on any monetary policy decisions and any decisions by the European Central Bank, which is becoming yours, part of your fabrics. And Bulgaria has a vote. Every member around the table, each of the 21 members, has a voice, which is regarded, considered, and respected exactly as the voice of the other ones, no matter how small or big the country. And I can assure you that in sharing those meetings and organizing the consultation, I respect that principle to the letter. I regard it as truly important. So, stability for price purposes, stability for monetary purposes. You are already part of the supervision mechanism that we have under the SSM, so you know about the stability of the financial system that is supervised by the SSM. But I think the cooperation, the collaboration will be even closer as of January 1st when you move. There's one point that I would like to make, and that happens regularly. Upon the joining, everybody has to convert from lev to euro, as we had to convert from Deutschmark, franc, lira, blah, 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 into euro. Sometimes, at the time of conversion, some shopkeepers, retail merchants take the opportunity of that conversion to increase a little bit the price that is charged for the same service. It happens. But I think you have tools, because my understanding is that since August, you have a converter and the necessary flagging of the price in lev and the price in euro. And therefore consumers can check whether the conversion is correct. And if there is, some discretion on the part of the shopkeepers and the retailers to add on, then certainly it's for the authorities to enforce the rule of strict conversion. And I very much hope that the authorities do that, because it's the rule, and it needs to be enforced. But we look forward to having you, and you will also, don't forget, being part of this market of 350 million people, your destination, whether it's for vacation or whether it is for investment, has a different face. The cost and the risk is in euro. Thank you.
And for the next question, we go to Olaf Staudig of the Financial Times. Olaf, please.
Thanks a lot. My first question is on the burden of proof in your data-dependent framework. It felt to many that until June, the burden of proof was kind of that data needed to disappoint or to surprise in one way or another to prevent another rate cut, while now it feels that the burden of proof is data has to surprise to potentially justify another rate cut. Is this kind of a fair assessment from your point of view, or how would you look at it? And my second question is is a conceptual question on bond spreads and kind of the European government bond market. So your communication on TPI is pretty clear and says you want to address disorderly, unwarranted market dynamics that undermine the transmission mechanism. How do you think about orderly and justified disruptions to bond spreads that may also undermine monetary policy transmission? I think the TPI doesn't really address this question, and I think it would be good to get some understanding of the government council's thinking on that one.
Well, thank you very much. I was not expecting less from you, but I tell you what resonates with me when I listen to your first question as to, whether it's the burden of proof is here or there to justify up or down or hold or blah, blah. I think there were many governors around the table who, after a good discussion on the inflation outlook, the underlying inflation, the strength of transmission, and the risk, there was a good discussion on risks. After all that, many said, look, let us not over-engineer, please. And I think they have a point. So, you give me a chance to actually make another point which is slightly different. But we are very lucky so far, and I hope that stays the same, to have data of which the integrity is not challenged. So the data that we receive from the statistics offices of the member states that are compiled by Eurostat, despite the trauma that we have seen a few years ago out of Greece, but despite that one, which I think has been a lesson for all of us, I think the integrity of the data that we use is very high, and this is valued by all of us. But we take all of that, the data that exist, the projection that we receive, the detailed analysis, the granular details in which we go down to understand underlying inflation, the assumptions that we make on the price of oil, on the price of gas, on price of commodities, the exchange rate, and we factor all that in. And it's on the basis of that mass of data that we try to organize as best as we can to see how it impacts inflation and how it helps us transmit our monetary policy stance that we decide. So I think that I would betray my governors on the Governing Council if I was to enter with you in that rather circumvoluted discussion about the burden of proof, which I was very familiar in my legal days, which was of a slightly different nature. So I think let's not over-engineer. Let's look at all the data. Let's look at all of them when they come, decide on a meeting-by-meeting basis, and make sure that we can continue to be in a good place with the decisions that we need to make at each meeting. Now, your second one. You're very familiar with TPI that you've just mentioned, and we have given a host of details and terms and conditions under which it operates. It's to be found on the press release that we issued back more than a year ago at the time when it came out. And you have to remember always that there is a set of criterias. There is a market assessment, and then there is the decision of the Governing Council. So it's in no way cast in stone, or it's not a straight jacket, and the discretion of the Governing Council always exists. Now, having said that, this is an explanation about TPI, because TPI was not discussed at all in the course of our Governing Council meeting.
The next question goes to Leonard Euxlitidis of Handelsblatt. Leonidas, please.
Good afternoon, and thank you very much. Firstly, I would like to come back to the inflation outlook, please. Last week, Isabel Schnabel again explained in detail why she sees the balance of risk tilted to the upside. You said you didn't discuss so much about the topic today, but can you tell us, did more governors today share Isabel Schnabel's view compared to July? Could you share some brief insights with us? And secondly, in July, your communication was interpreted as more hawkish. Were you surprised by that? And do you feel comfortable with the fact that markets now less likely to factor in further interest rate cuts? Thank you very much.
That is 3 questions, so I will discount your third one. Okay. 2 is already a stretch, but 3, no. You know, as I just said, particularly because we have now agreed on the strategy review, and that one of the changes that we have all agreed is to discuss around the baseline the risks. We had that good discussion of risks. Risks to growth, risks to inflation. We do not ever settle on risk to inflation as to whether it is to the upside, to the downside. We mention a number of factors that constitutes risk to the upside and risk to the downside. And this is all sort of highly technical and subtle, because depending on where you are and where you want to be, those risks to inflation, to the downside or to the upside are either good or bad. So you have to enter into, now I would go back to my previous questioner, that is a bit circumvoluted. But we do have those discussions, and we did have it yesterday and this morning, and it resulted in the risk paragraph that you have in the monetary policy statement, which starts with, and I will quote it for you if I find it right away, risk to economic growth have become more balanced. And I tried to explain why we came to this conclusion as compared with risk to the downside, which was incorporated in our June monetary policy statement. It relates predominantly to the trade situation and the risk level resulting from no agreement, an agreement, possible retaliation, no retaliation. This was clearly a trigger to say that it is more balanced. I'm sure that you will hear people say, well, it's more balanced, but a bit to the downside. Yeah, of course. But risks are going to arise. Some of them will be new. Challenges will be new. And, you know, there are reasons to fear, there are reasons to hope. And what we're saying here is that it is more balanced now than it was back in June. See, I've lost sight of your second question, but I think you characterized me as expressing hawkish statement, or I was interpreted as being hawkish. I remind you that I'm neither hawk nor dove, I'm owl. For our Bulgarian colleagues, you know, when I first took this job, I was instantly asked as to whether or not I was a hawk, the hardliner, or a dove, the softer liner. And I said neither. I'm an owl, because I want, number one, to see everything that happens around me. It's not 360 degrees, but it's a pretty large diameter that I can look at. And I want to come to my conclusions having heard all colleagues around the table. And I think that during my July communication, I expressed exactly what was felt by a very large majority of my governors around the table. And I think I've, as mentioned earlier, repeatedly said that we continue to be in a good place, which does not mean that we are on a predetermined path, because we have to decide meeting by meeting, because we are data dependent, and because we have to face the risks and challenges that are coming. Thank you.
So next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you very much for the opportunity. So
Okay, guys,
question
market
on
is
the
open.
resilience
Lagarde
of
is
the
speaking.
euro economy. How far is this resilience one of the reasons for holding rates unchanged? And my second question, if I may,
I like
is
this rally
still
because
on
I'm
the
gonna
good
short
place where the
more.
ECB is. Could we also think that it could be a pause in the direction of a rate cut, in the sense that is there a direction of travel, which is an expression you used?
Okay, enough with Lagarde. Enough with her bullshit. Let's see. Okay, let's short.
Order filled.
We short 99. Market keeps pumping. We don't care. We have this gap unfilled at 860 area. I'm gonna cover those shorts.
Order filled. Order filled.
Okay, let's go. Dun, 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 dun. Let's go, chat. And here we go. Plants, baby! Make some 50 points profit. Let's go! Plants, baby! Oh no. Cancel this. What else we have here? Euro.
Order filled.
Come on. What are they? What are you doing, chat? So now we go. Okay. Oh, I forgot this. Come on, plants, baby! Okay, I think enough for today. Thank you all for being here.